Okay, so this video is going to cover the consolidation process, which is simply when you're looking to add the assets and liabilities of a subsidiary to the assets and liabilities of the parent company to make one consolidated group. So to start off with, we're going to look at how we actually record the acquisition of a company. And we're going to do that through an example here. So Ben Limited issues 10 shares to existing shareholders of Company B at $10 each to acquire the company. So effectively what Ben Limited is doing is issuing 10 shares worth $10 each, so $100 of its own shares to existing shareholders of Company B in exchange for the actual shares of Company B. So Ben Limited now owns Company B, and the old shareholders of Company B now own some of Ben Limited. So the way we record this is we debit the investment in the subsidiary for Ben Limited, so that's $100 because that's how much was paid effectively, and we'll credit the share capital of $100. So basically if Ben Limited paid cash, then we would simply credit cash instead of share capital. So consolidation journals, just a few general comments to start with. Now, they do not create a permanent record in the general ledger, and so this means that we need to start again every year. So if we posted one consolidation journal last year, we're probably going to have to post it again this year. And it's because of this that a lot of the entries have to be repeated every year. So the purpose of these journals is to remove double counting when we add up the assets and liabilities of each entity, which we'll go through how this can happen in a second. So in general, to eliminate the parent's investment asset, we record this entry. So we debit the equity of the subsidiary and we're crediting the investment of the parent. So this general entry is only applicable when the amount paid for the investment is equal to the amount of the net assets. So the reason we do this elimination is to avoid double counting, as mentioned before. Now, I'm just going to go through how this can happen and explain it. So you can see here that we have the parent balance sheet and the subsidiary balance sheet. And so the consolidation process is going to aim to add up all the assets of the parent and all the assets of the subsidiary, and then put it on one consolidated balance sheet. So you can see here that the investment asset is worth $50. Now this investment line item is equal to the net assets of the subsidiary. So you can see that the net assets of the subsidiary are equal to $50, which is equal to the investment asset. So this is the reason why we're eliminating the investment asset, because when we consolidate, we'll bring the machine asset and we'll bring the cash asset over to the consolidated balance sheet. So the values of these assets equal what the old investment asset was, and so our balance sheet still works, i.e. $150 of assets, $150 of equity. And so the reason that we are eliminating the subsidiary's equity is because the equity that existed to offset the investment asset still remains for the parent, and because we got rid of the investment asset, the assets of the subsidiary take over from offsetting that equity. So that would leave us with this consolidated balance sheet, $150 of net assets, $150 of net equity, with that investment asset representing the net assets of the parent, of the subsidiary, which was $50 through the machine and cash. Okay. So next we're going to look at a goodwill or bargain purchase. So goodwill arises when the consideration transferred, so essentially saying how much we pay, is greater than the net identifiable assets. and goodwill is only recorded on consolidation. So if we pay $1 million, but our net assets are only worth $900,000, then that would be $100,000 of goodwill. And the opposite, a bargain purchase arises when the consideration transferred is less than the net identifiable assets. So if we pay $800,000, but there are net assets of $900,000, effectively we have a bargain of $100,000 that we've made. And so that's good for us as the company. And so we actually have to treat that as a gain through the profit and loss. Now we determine if it's goodwill or bargain purchase through an acquisition analysis. So we've got an example here. We're going to look at goodwill. So Ben Limited acquires QCO for $1 million on 1 July 2015. QCO's equity is comprised of retained earnings $700,000 and share capital $200,000. So on 30 June 2016, goodwill is impaired $30,000, and at 30 June 2017, another $20,000 of goodwill is impaired. To record all consolidation entries for 30 June 2016 and 30 June 2017. So we have our acquisition analysis. So we know that we have paid $1 million, and we know that the net assets are represented by the total equity of the company. And so we have the $700,000 of retained earnings, the $200,000 of share capital that we just got from the question. So that's $900,000 in total. So we've paid $100,000 more than the net assets. So that means that there's $100,000 of goodwill. Okay, so now that we've worked out how much the goodwill is, we can record the consolidation entries. So the first thing we need to do is we need to eliminate the investment asset. So we spoke about before that the general entry is that we're going to debit the equity of the subsidiary and we're going to credit the investment of the asset. But because we've paid more than the assets of the subsidiary, there's also some goodwill that we need to recognize to balance out our journals. So we'll start off recording the equity, or debiting the equity to eliminate it. I have debit retained earnings. We know that amount is $700,000 from the question. Debit share capital, which was $200,000 from the question again. And we're going to recognize the $100,000 of goodwill. The reason we need to recognize this $100,000 of goodwill is because we record our investment at cost. So it cost us $1 million. And we know that the net assets that we have acquired are $900,000. So if we were to just add the $900,000 worth of net assets, this wouldn't be the same as the $1 million of investment asset that we had recorded on our balance sheet originally. So we need to record another $100,000 of goodwill to ensure that we're replacing that $1 million investment asset with another $1 million of assets. So once we've eliminated the investment asset, we need to impair the goodwill because we were told in the question that goodwill needs to be impaired. So it said $30,000 of impairment need to be recorded for 2016. So that's what we're focusing on now. So we'll debit the impairment loss for goodwill. So this is a loss that goes through the profit and loss. It's $30,000. And we will credit accumulated impairment for goodwill the same amount. So that's nice and simple. Okay. So we'll now move on to doing the entries for 2017. So when we're eliminating the investment asset, the entries will remain identical for subsequent years when goodwill is involved. So effectively this means that it's just a copy and paste of the exact same entries we did for last year, and we'll do that going on year after year after year. However, goodwill changes. So we know that we need to impair an additional $20,000 for 30 June 2017. So we'll debit the impairment loss to recognise that additional payment for goodwill for 2017. So that was $20,000. And we also need to recognise the $30,000 that we impaired last year. However, to do this, we're going to debit retained earnings, so the opening balance, for the $30,000 that we impaired. And the reason we do this is because the impairment loss goes through the profit and loss. So you know that if you make a profit, say for $50,000 for a year, when it comes to the next year, you take it back to zero because that profit is transferred into retained earnings. So you don't start the year and go, yes, I'm on $50,000 profit, you're on zero. But because goodwill is only recorded on consolidation, we need to make that adjustment to the equity to reflect the fact that there was actually a loss on goodwill. And so we need to record that in the retained earnings. Now, this is because we're going to credit the accumulated impairment for goodwill. So it's now $50,000 when we add both up. So that means when you offset accumulated impairment with the actual goodwill asset, this will only be $50,000. So this $20,000 will reduce the equity by $20,000 for this year's profit, and the $30,000 adjustment from last year's impairment will reduce the equity another $30,000. So we'll reduce equity a total of $50,000 to reflect the fact that goodwill will only now sit as an asset of $50,000 when you look at this credit for the accumulated impairment goodwill and the debit of 100,000 goodwill, they're only adding up to 50,000. The other thing to note is that the impairment of goodwill cannot be reversed. Okay, so now we're going to look at bargain purchase. So Ben Limited acquires QCO for $1 million on 1 July 2015. QCO's equity is comprised of retained earnings, $700,000, and share capital of $400,000. So record all consolidation entries for 30 June 2016 and 30 June 2017. So we can do our acquisition analysis here. So again, we know that we paid $1 million, but this time we know that our net assets that we acquired were actually worth $1.1 million. So that means that we made a bargain purchase of $100,000, i.e. we paid $100,000 less than what the fair value of the assets we were acquiring were worth. And so we've made a gain that we'll recognize through our profit and loss of $100,000. So the way we're going to record our elimination of the investment asset for our consolidation entry for the 30 June 2016 is quite similar to goodwill before. So we'll be debiting the retained earnings. We're eliminating our equity. This was $700,000. Again, we'll debit share capital. This time it was $400,000. And we will want to credit our bargain purchase gain, because remember I said that this was a gain that is recognized through profit and loss. So this is increasing profit, which is increasing equity. And so to increase equity, we credit. So we worked it out to be $100,000. And because we record our investment at its cost, we'll credit that for $1 million to eliminate it. And so that is how you eliminate the investment asset in the year of purchase, the bargain purchase. So for 30 June 2017, it changes slightly. So our debit of retained earnings and share capital, as well as our credit of the investment, remains the same. So our equity accounts here will remain, the investment will remain because we're always recording at cost. But the bargain purchase, remember I said that was considered to be profit, effectively, of $100,000. So what happens at the end of the year is that you close off profit, you transfer the profit to retained earnings, and so that means that your profit or loss starts again at zero. So rather than crediting bargain purchase, because this would impact the profit for this year, even though nothing's happened this year in relation to this acquisition, we will credit the retained earnings opening balance. All right, for that $100,000. Now, this is because the net assets will be worth 1.1 million when we consolidate our financial statements. So there'll be 1.1 million assets of the subsidiary that we will add to the parent, and there will only be equity worth $1 million to offset this $1.1 million worth of assets. So by eliminating this investment asset of 1 million, we'll be replacing it with $1.1 million of assets. So we need to ensure that we increase our retained earnings balance by the $100,000 of the gain that we actually made on the acquisition. It's no longer a gain this year because it happened in a prior period, so it shouldn't go through the profit, but we just need to make sure we make that adjustment to retained earnings to ensure that the equity of that purchase is reflected on our consolidated statements. Okay. And then in subsequent years as well, this entry will stay the same as it is here. We'll debit retained earnings share capital, credit the investment, and we'll credit retained earnings opening balance, again going forward. So next we're going to look at dividends declared at the date of acquisition. So if the subsidiary has declared a dividend, you can either acquire the shares ex-dividend, meaning you're going to be excluded from the dividend payment. So the dividend will be paid to existing shareholders, and there is no change to the process we've just gone through above. Now the reason for this is that when you declare a dividend, you will record the dividend payable liability on your balance sheet. This will reduce the net assets, and so when you acquire that company, the net assets will already be reduced by that payable amount, and that cash will go to an external party and will have nothing to do with you. And so there is no change. However, if the dividends are that means that the dividends will come to you, i.e. will be paid to the acquirer. As a result, that dividend will need to be deducted from the investment account. Now the reason we do this is, say, if I'm going to buy a company for $1 million, but I acquire the shares come div, I'm effectively paying $1 million to buy the company, but also for the right to receive, say, $50,000 in a dividend. So if I pay $1 million, I'm then going to receive $50,000 from that company I've just bought. I'm effectively only paying $950,000, and that's why the dividend's deducted from the investment account. So we'll go through an example. So Ben Limited acquires QCO shares for $1 million on 30 June 2016. QCO's equity is comprised of retained earnings $700,000, share capital $200,000. QCO has declared a dividend of $50,000 payable on the 1st of August 2016. The shares were acquired come div. Record all entries for 30 June 2016 and 30 June 2017. Okay, so first we're going to record the entries for the actual acquisition of the company. So we're going to debit investment because we're buying the company, so we now have an asset which is an investment in this company. And we know that we paid $1 million. and we will credit cash, because we paid $1 million in cash. So we also need to record the fact that we are entitled to receive a dividend, so we'll record a dividend receivable of 50,000, and we will remove this from the investment account, $50,000, because of what I explained before. We're paying $1 million to buy the company, but also for the right to receive $50,000. So we're effectively only paying $950,000. So when you add up the debit of the 1 million, take away the credit of 50,000, this totals to 950,000, which represents our effective cost in acquiring the company. And then when we actually receive the dividend on 1st of August 2016, we need to record this. So we'd receive cash of 50,000, so we'll just debit cash. And we'll no longer have a receivable for that dividend, so we'll just remove that from our balance sheet by crediting dividend receivable. Okay, so now we've actually recorded the acquisition in our general ledger, we can do this acquisition analysis. So again, as I've explained before, the effective price we're paying is $950,000. So the 1 million that we actually paid minus the 50,000 of dividend that we received from the company. So then there's this $900,000 of net assets that we're acquiring. So we've paid $50,000 more than the net assets. So that arises $50,000 worth of goodwill. So we're going to eliminate our investment asset as we've done before. So we'll be debiting retained earnings. And so we know that's 700,000. We will debit share capital, which again we knew was $200,000 straight from the question. We'll debit goodwill, $50,000 that we worked out from the acquisition analysis. And then we will credit our investment asset for $950,000. Okay, so we also need to eliminate the intragroup transaction. So, because we're recording at 30 June 2016, we acquired the company at 30 June 2016, and the dividend was payable at 1st of August 2016. So that means at this point in time, QCO will have a dividend payable on their balance sheet, and Ben Limited will have a dividend receivable on their balance sheet. However, because Ben Limited now owns QCO, if you put them together as a group, right, QCO will be paying Ben Limited. So as a group, they're one same thing. So effectively, there's no longer any liability or no receivable because they'll be paying it within the group. And so there'll actually be no benefit to the group as a whole. It'll just be going from one legal entity to another legal entity within the group, so there's no actual net benefit. So what we want to do, we want to remove the liability from the books of QCO. This is only a consolidation, we wouldn't actually remove it from the books, just an adjustment for consolidation. So we debit dividend payable 50,000 to offset the credit that QCO would have on their books. And we will credit the dividend receivable to remove the receivable asset that Ben Limited would have on their books. So that would mean that there's no asset or liability recorded on consolidation, because effectively, otherwise we'd just have a dividend payable of 50,000 and a dividend receivable of 50,000, and they'd net themselves off anyway if you added them up on a consolidated basis, but they don't actually exist when you consider the two entities as one group together. So that's why we're eliminating them. Okay, so if we're then looking to record the consolidation entries for the next year, 30 June 2017, our elimination will be identical this year as well as in any years following. However, we'll no need to no longer need to eliminate this intragroup transaction for the dividend payable because it no longer exists. The dividend was paid on 1st of August 2016, so QCO would debit their dividend payable to remove the liability from their books and credit cash, and Ben Limited would debit cash and credit the dividend receivable. So QCO would get rid of the dividend payable, which was this part of the elimination entry, and Ben Limited would credit the dividend receivable, which is this part of the entry, and so they would simply no longer exist on either of the books of the entities, and so there is no longer anything to eliminate. So the last thing we're going to look at is just when the subsidiary changes pre-acquisition equity. If they do that, then we need to reverse any changes to restore it to the pre-acquisition balance. So we'll just go through a quick example. So on 1 August 2016, QCO transferred $10,000 to the general reserve from retained earnings. So in the books of QCO, which is a subsidiary, they would record these journals. So they would debit the transfer to the general reserve. That's coming from retained earnings, $10,000, because they're trying to take something out of retained earnings, putting it into the general reserve. So they'll credit general reserve to increase the balance of that. So that's also by $10,000. So that's what the subsidiary would record. However, if we were consolidating the financial statements of the subsidiary and the parent, we would want to reverse that change they made to the equity. So we would simply record a transaction on consolidation that is directly opposite to this. So we would debit general reserve $10,000, which will offset this credit to the general reserve, so it will net to zero. And we would credit the transfer to the general reserve. This is retained earnings it's coming from, $10,000. So that this would net off with this debit coming to zero. So this would restore the pre-acquisition equity balances as they were before QCO made this change. Okay, so that's the end. I hope the video was useful.